Janali, have we actually seen any IPOs getting delayed or perhaps even pulled?
So Warner Music and Cole Haan are the two that people are talking about that have delayed their IPOs. There's a specialty chemicals company that has a lot of exposure to China that Carlyle owns that has also been delayed because of a lot of these global fears around the coronavirus. Remember, volatility in the markets has been hitting levels that are higher than the highest levels we've seen at any point last year. And so it's really hard to take a company public when you just don't know what the investor appetite will be for buying those new shares.
And Airbnb was arguably the most hotly anticipated IPO of the year. And it's uniquely hit because not only is it an initial public offering, a potential unicorn in this environment, but they also are more directly hit by the travel sector and the sort of slowdown there.
That's absolutely right. Because remember, in 2017 and 2018, my colleague Olivia Carville had written that they were profitable those years before interest and amortization and depreciation. In 2019, that was not the case. And that was before the coronavirus even started to impact travel. And they've been letting guests going to China cancel their reservations without any penalty. So yes, does it take an impact to the revenue stream and potentially their bottom line? Absolutely. That's a hard thing when your valuation has been propped up to $31 billion in the private market already.
Meanwhile, over in emerging markets, there's a question about the epicenter of the outbreak. It was in China. There's a question of how it's moving around the world and how it's affecting the developing markets. Damian Sassower with us. Can you get a sense, based on the fact that we're getting a 50 basis point rate cut from the Fed, the first emergency cut of this nature intra-meeting since the crisis, what will the effect be on demand for emerging market assets?
Well, emerging market local currency assets are still going to suffer, in my opinion, simply because the markets need to take time to come to grips with exactly what is happening here in terms of how low are we going to go in yields. But one thing is absolutely certain. If you're looking at U.S. dollar asset classes like investment grade, high yield, and emerging market U.S. dollar debt, what it does, these falling yields, is it leaves spreads that much wider. And what that means is that it's going to be idiosyncratic factors like sector, country-specific issues that are going to drive returns, in my opinion, going forward. And so that's something that markets need to keep a closer eye on.
There's a question over the past decade, the low interest rates has pushed more investors into private market assets seeking higher returns and into emerging markets in particular. I'm just wondering why that argument won't necessarily take hold this time.
Well, I think a lot of that is going to be short duration debt, quite frankly, and that's going to obviously get hit when the front end is falling, and what we've seen in markets, right? I'm talking bank loans, I'm talking private debt. A lot of that is shorter duration of nature. Emerging market dollar bonds are much more longer duration in nature, and certainly the investment grade component of that, what you see is that, spreads are now almost 50% of yield to worst. I mean, that is 1 to 1.5 standard deviations above the 10-year average. It's pretty big. A lot of juice there for markets to basically extract some spread return over the near term.
Given the fact that China was the epicenter and that the supply chain to the U.S. was not the only one, but also Southeast Asia, are there other economies that you think will be uniquely impacted to the negative, to the downside, that perhaps people are starting to pull their money out of?
Yeah, no, I mean, you're definitely seeing people pulling their money out of Indonesia. Indonesia government bonds, which has been a star performer for the better part of the last year. You've seen a lot of outflows of recent days and recent weeks, quite frankly. But I think really you have to take a step back and you have to differentiate, like you said, between local currency and hard currency. And it's going to be a hard currency play. If you're going to invest in emerging markets, you're going to want to do it on a dollar-denominated basis in this market because you just don't know where the dollar is going to go next.
And that really goes to the heart of the question of the day, of the year, which is the Federal Reserve responding in an emergency sense to stimulate the economy or responding to a reality that means less demand, less growth, lower oil prices, which we've already seen this year, which brings me to you, Allison. People wondering how many more bankruptcies will occur in the shale patch, given the fact that we're seeing ongoing distress in some of these oil companies. Can you give us a sense of what we're seeing so far based on the plunge in oil valuations that we've seen year to date?
So yes, we've started to see more energy companies selling off yet again. This has been an ongoing theme for energy companies. How much further do they have to go? But with oil now below $50 a barrel, that's really sort of a psychological pressure point for investors, and that's largely driven by coronavirus fears of a global slowdown, which would mean less demand for oil, less demand for natural gas and those sort of products. And so it's really all kind of mixed together. And that's also happening at the same time as we've seen energy companies reporting really disappointing earnings, not meeting their production targets, not meeting their earnings targets. So with lower oil, expected lower demand, and disappointing earnings, people are starting to expect that we might see more bankruptcies in the energy sector.
Well, Allison, that's where I wanted to go with this, is how far in the washout we are, because I remember back in 2015, 2016, it got pretty ugly and people said, okay, we're all clear, we've had some kind of catharsis. This time around, how close are we to that?
So we're still a ways away from what we saw in 2016. In 2019, so last year, we actually saw the highest number of bankruptcies since 2016, but this year it's been fairly muted. What we're seeing is really sort of distress in the price of trading, so in bonds, in loans, in equities, but we haven't yet seen that uptick in filings, although people are certainly watching to see if those trading numbers, of those earnings results, of those oil prices will lead to more bankruptcy filings.